It's a great trade. We did a story about a year ago, and it was the day of the Facebook IPO, and everybody was yelling and screaming and excited about that. And meanwhile, I went down to Atlanta and would drive around the suburbs, and you would see perfectly fine houses for $75,000 a house. And you thought to yourself, wow, this is a great opportunity. Well, why don't we transfer, sticking with real estate, to commercial real estate? As central banks around the world depreciate their currency, people tend to be flocking towards real estate, whether it's London, New York. We tend to look at the cap rate and the amount of income versus divided by the overall price of the asset. Cap rates for, I guess, premier assets in New York City are now, what, under 4%, 4%? Meanwhile, suburban assets are probably double that, 8 or 9%. Can you just explain kind of what you're seeing kind of in these core markets versus the suburban markets?
Sure. So generally speaking, because REITs are, paying out cash yields, maybe 3%, 4%, their hurdle rate is actually much lower on a cap rate than ours would be. And because of all of the liquidity that you're just seeing infused around the world, real asset prices have gone up a lot. And so as it relates to stabilized assets in core markets, there's just huge demand for that. And so we find ourselves now at this interesting time where there's still an opportunity to buy stressed and distressed assets, although it's harder in the US than it was, but Europe, obviously there's quite a bit. We then take time and put capital in to fix them up, stabilize them, and then ideally sell them into the core market. In addition to the core market, though, we're also seeing demand by sovereign wealth funds. And as I indicated earlier, they, just like pension funds here, they need to have yield, and they want long-term stable assets. And so both of those groups, which have very large pools of money, are interested in the fully leased building. And so, we've bought stuff over the last 6 years that's looking a lot more stabilized, and so those prices have gone up a lot. I would say suburban, so core markets, whether it's here or Europe, so London, Paris, West Coast here, the coasts here generally have moved up quite a bit. You're still seeing higher cap rates in suburban, largely because the take-up hasn't been that quick. In a very slow economy, even though there hasn't been much in terms of supply coming on the market, there also hasn't been a big increase in demand. But I think those markets will likely follow the core market trend, which they tend to lag and then move. I don't know if they'll ever get to the same lower cap rates, but directionally they'll probably be similar. And we've done some buying in non-core markets.
Can you discuss, sticking with real estate, what you're seeing internationally, whether it's Europe, whether it's Asia?
Yeah.
I mean, what's cheap out there?
Yeah, it's hard to find things that are truly cheap other than when there's a forced seller. And as I think back to everything we've bought since 2008, it's hard to actually find anything that we bought where we weren't buying from a forced seller. And, unlike prior downturns, these weren't forced sales because there was oversupply. It really was that they were forced sales because of over leverage. And the supply dynamic is attractive, and so it makes it a pretty interesting proposition for us to come in, put in equity, or buy debt at a certain level and ultimately own that asset. So I would say Europe for us is looking very attractive right now, and we think there will be large sales. So the combination of bank reform, Basel III, which causes the banks to reduce their lending, and also ultimately they'll have to start selling assets. So those two things really allow for or cause dislocation in the market such that lenders can't get new financing. And so if you have a loan that's coming due over the next year, you need to find a solution. And the math just doesn't work. If the banks are shrinking, there's just not going to be that same level of debt. Not everyone will be able to roll over. And it's quite significant, not just in real estate actually, but for corporates in Europe as well. And unlike the US, on top of that, you don't have large, deep public markets as it relates to credit in the same way that you do here. And so there just aren't a lot of alternatives. And so private transactions, both on the debt side and in equity in real estate in Europe, I think are attractive. Asia, you almost have to divide into two different worlds. So you have the more mature countries that where I would say the trends are not dissimilar to what we're seeing here, and that's areas like Japan and Australia. So mostly we've done distressed investing there. And then you have emerging Asia, India, China, and Southeast Asia. And we really avoided those for quite a long time. They're looking more interesting now. Pricing is down. And similarly, you have over-leverage. Markets are absolutely less heated than they were. But there's definitely more development and in both India and China. And some of that's interesting. We recently partnered with someone with a company that was over-levered, very high-quality office park, good tenants, global tenants, but they needed the capital to finish, the fourth building. And we partnered with them on that, and that was quite interesting.
Why don't we transition to private equity, probably what Blackstone is maybe best known for. Over the past couple of months, we've seen people sell their assets. I know Blackstone has sold SeaWorld and Pinnacle Foods. Clearly, the markets are up. They seem to go up every day. I would imagine, though, it's tough to find cheap companies when the market is this high and when you have to pay a premium. Can you kind of walk us through what you're seeing out there?
Yeah. So 2 points, one on the realizations and then one on the purchases. So as you think back 12 months prior, absolutely realizations have accelerated since then. Equity markets, as you would imagine, are with equity flows coming in the last 17 weeks, fund managers needing to put that money to work, it's easier to get deals done. Investors are looking for good opportunities. And as you think about U.S. markets versus other markets in the world, which is how you have to look at it, of course, I think similarly investors aren't seeing a ton of places to put money, and so you've considered to have global investors move their money here. And that's a different trend than it was in the prior several years. So we are, for the companies that we bought several years ago that are now more mature, where EBITDA is stable and growing, we're able to take those public, and we've been doing quite a lot of that. On the flip side of that, in terms of purchasing, I would say not just this year, but the last few years, things have looked and felt expensive. And we need to pay a premium, often 20% plus, to whatever the public mark is, in order to take control, the control premium. And so we can't even just look at a market price and say, oh, $30, that's reasonable, because likely we'll have to pay 36 or 37 and then still get our 20% return. Now, of course, there's some leverage on there that aids in the return, but you want to be sure that you're not just putting out capital at expensive pricing. And so we've really gone in a different direction, not just the last year, but I would say almost over the last decade. As more capital has come into private equity and the bidding wars began to happen, we moved away from the largest public to private deals and much more towards mid-market transactions or build-ups where you start with a small deal and then you act as a strategic and you add on other transactions, or where we've identified a very strong management team and we'll provide the capital, we'll back them up, and we'll just build a company. And so some examples, actually SeaWorld is probably a good one since we just took that public. So SeaWorld was a company we had been looking at for years, and Anheuser-Busch didn't want to sell it. But when they were actually taken over, their parent company felt that it was a non-strategic asset. It was down part of the cycle, so we were able to purchase it at quite a good valuation. We put much more capital into it. Actually, they're opening up a new exhibit that's supposed to be phenomenal, the Penguin exhibit, Antarctica, I guess it's called soon, but that takes a lot of capital investment. And so they've had tremendous growth, EBITDA even through the recession, and the market was very receptive to that IPO. In terms of, we backing management teams, Tom O'Malley was someone we had worked with in the past in the energy space. Refinery assets were trading at 5-10 cents on the dollar. And so we started buying those, accumulated them, formed a company, PBF, which is also now public, and Pinnacle Foods, which you mentioned too, so I'll use that as another example. We were able to act as a strategic buyer and add on and just make it a stronger company than it was in the past. But I would say just going out and bidding a big premium, when the market on average is paying 15 times earnings and the economy is growing at a very slow rate, if you were just talking about the market in general, is difficult. That said, we're also very bottoms-up driven, and so there are often transactions you can find where you can still get a good value, but we've absolutely veered in different directions.
The company decided to pass on Dell. Can you describe what the ultimate reason was for passing on that potential transaction?
Sure. So we were interested in it for, I guess I can't really go into great detail, but for several reasons. We saw value beyond the basic franchise, and one of the partners in private equity is actually the former head of strategic planning at Dell, so he obviously knew the company really well. But when we went in and did the deep due diligence, ultimately, it was right around the time the company had also lowered its guidance. And so initially what we thought the cash flow over the coming years was going to be was knocked down by a fair amount. And so there was just no way for us, given price, to meet our 20% hurdle. And so we walked away.
Is the biggest risk now in private equity that stocks just go higher and higher and you can't deploy capital, almost the melt-up phenomena?
Well, I actually do think if you are a firm that is tied to public to privates, which several firms are, you will have a very difficult time putting out capital. If you are, perhaps tied to one region, that also makes it difficult. We've always operated with a global fund, multi-sector fund, just for this reason. So if Europe's not looking attractive, we won't invest in Europe for 2-3 years, and that's totally fine. Right now, Europe's looking a little bit better, and so maybe more money will get deployed there. But, we're fine slowing the pace. Real estate, we did the same. 2008, 2009, we did very little until assets stabilized. So, I don't think you want to chase companies and lower your bar. I think that always hurts. And when you look at the correlation of returns in private equity, they tend to correlate most closely with vintage year of investment. So there, of course, are a lot of other factors and certainly improvements that you can make to the companies. But, investing at lower multiples, bottoms of cycles, absolutely helps. Fortunately, not every sector trades together, and so you can find counter-cyclical trends. And so we tend to like sectors that are out of favor, that people are just not interested in at the moment.
Why don't we transition to credit? Bond yields around the world are coming down. Junk bonds in the U.S. now yield maybe, 5%?
Yeah.
Leveraged loans are around 5%. Nobody seems to be defaulting. They can refinance. What's attractive now in credit?
So credit's definitely more challenging, and we've had to transition from buying off of the screen, buying high-yield debt in the market, to originating and private transactions. That's probably the biggest change over the last 18 months or so. I don't think that we'll be able to get the same return, that we did maybe the prior 2 years, but that was well in excess of the targeted return regardless. And, as we mentioned, compared to what's out there in the market, we still are able to get double-digit returns. But I think you have to be very selective. You have to have a real credit mentality. We've been fortunate. Our loss rate over time has been less than 1%, and we only traffic in high yield, so that's a very low default rate. So I think you have to be quite careful with credit. But the opportunity for us is we really, like in our funds, mezzanine funds, in our opportunities funds on the credit side, we really focus on small to medium-sized companies. Those are the companies today that have the toughest time rolling over their debt with banks, and and we still have a lot of capital to move, and so we're able to come up with structured solutions for those companies. But I think it's absolutely today a lot more challenging than it was.
Do you come across a lot of companies where maybe they should just fail? Maybe they're poor companies and the credit markets are allowing them to live another day and another day, and maybe you can't get the poor companies out and have a new cycle begin?
Okay, so we have one of the biggest restructuring advisory groups. So certainly Tim Coleman, who runs that business, would probably argue with that. I think they look at the ability for companies to roll debt at very attractive rates, and seemingly companies that you wouldn't imagine could, and just think, like, wow, what is going on? And that to them feels like a credit bubble. It's always hard to say that you'd rather have a company go into receivership than be able to roll over and live to fight another day. And, the reality is out there, credit is very cheap. And so if you have the opportunity, I think about our private equity portfolio, any opportunity we can, we absolutely extend maturities, roll over, lower the rates. As you mentioned, deals are happening all in rate of 5%, and even maybe lesser credits at 6%. It's completely unprecedented at any other period in time. So that said, I will say our restructuring group is surprisingly busy. So even though companies can find debt, there's still a fair number that are struggling. And while the wall of debt of maturities has moved out, it's still quite a big wall. But as long as rates remain low, the pressure is off a bit because the cash needed to sustain your interest payments has just gone down.
Yeah. And people thought there would be lots of opportunities in Europe in credit. Have we seen those opportunities? That was the big opportunity a couple of years ago.
Yeah. I would say right now half of our backlog is coming from Europe. So we're definitely seeing increased opportunities. It's interestingly, we were not believers that the opportunity was going to come from these huge wholesale, bank sales, and so we didn't set up that way. In the way we were viewing it was more what we do in the U.S., which is one-on-one, individual credits, small, mid-sized companies, and we are absolutely seeing that. The other trend that's interesting is, the CLO business, which everyone thought was completely dead, is not. It's actually alive and well and growing, and and that's emerged here and in Europe too.
So when we see 30 billion of CLOs issued so far year to date, what do you make of that? Is that just a drive for yield? Is that people reaching for yield?
Well, you're seeing, I think it's that they've actually performed, it's an asset class that has performed well. We're not in a period where there are a ton of defaults. And so, I think folks have looked at how their CLOs have performed. They've done well. As they mature, they're willing to put more equity in, roll them over. So that's one. And second, absolutely, I think there's a drive for yield that is hard to find. The other area of credit we didn't really talk about, but with interest rates so low, it's hard not to ask, well, what if interest rates go up? Which at some point...
We ask that all the time, by the way.
They will, right? And so I think the other product that investors are looking for is variable rate credit. Where can you get good returns in variable rate credit? And we have a couple of products that serve that as well.
So given that low rates are impacting the way you think about real estate or credit or private equity, can you compare the biggest difference now versus at any point in your career in terms of investing in those areas? I mean, what's obviously low rates changes things, but does it make the environment feel artificial?
So it's, at any point in my career, I've thought, different things were a bit out of sync, either feeling a little expensive or cheap, whatever. But, if you take the markets one by one, certainly over the span of my career, 15 is not a crazy multiple. It's pretty average in the U.S. But I think what's a little bit different is that the growth rate or the expected growth rate of companies is marginal. So a 15 multiple with a 2% or 3% growth rate, is that really sustainable? It argues that either growth will have to accelerate or, maybe multiples will compress a bit. But I think you have to look beyond that and probably dig more into sector by sector, because there are absolutely varying trends within that. As you think about credit, I don't think we've ever seen credit trade the way it's trading today, but there's so much liquidity coming from governments around the world, and you just don't see that immediately changing right now. So I'm not sure what the catalyst is in the near term for that trend to shift from what it is, but it feels unsustainably high.